The year is 2025. Wars rage, inflation bites, and yet the stock market keeps climbing. To the average person, it feels unreal. Companies lay off thousands, but their stock prices soar. Banks wobble, but Wall Street smiles. What's really keeping this system alive? The truth is, it's not confidence, it's architecture. The market isn't a reflection of the economy anymore. It's a machine built to survive it. Hidden mechanisms, from buybacks to liquidity injections, keep the illusion intact. But for how long? In the 20th century, markets reflected growth. Factories boomed, profits grew, and stocks followed. But today is different. Wages stagnate while corporate valuations soar. The link between real production and financial reward has quietly broken. The economy now runs on perception, not performance. As long as investors believe the show must go on, prices keep rising. It's not about earnings, it's about expectation. The market has become a story we tell ourselves, a narrative powerful enough to shape reality itself. After 2008, the world changed. Central banks, led by the Federal Reserve, began rewriting the rules. Interest rates fell to zero. Trillions were printed in quantitative easing. What began as a rescue mission turned into a lifestyle. The markets became addicted, not to profits, but to policy. Every whisper from the Fed now moves billions. The market's survival isn't organic anymore. It's engineered. The invisible hand isn't Adam Smith's, it's Jerome Powell's. In the last decade, U.S. corporations spent over $6 trillion on one thing, their own stock. Not on innovation, not on workers, but buybacks. This self-feeding loop inflates prices even when demand is weak. It's like giving steroids to a tired athlete. Performance looks strong, but the body's exhausted. Buybacks are Wall Street's mirror trick, turning stagnation into shine. And as long as rates stay low, the illusion survives. Markets thrive on one thing, liquidity. The ability to buy and sell instantly gives confidence. But that liquidity is often synthetic. ETFs, derivatives, and high-frequency trades create a surface calm, while underneath instability brews. It's like a frozen lake, smooth on top, but one crack could shatter everything. When liquidity disappears, so does trust. And without trust, the market isn't a market at all. Markets are no longer built on fundamentals. They're built on faith. Faith that central banks will intervene. Faith that inflation will cool. Faith that profits will return. It's not numbers holding it together, it's narrative. The modern investor is part economist, part psychologist. And that's the irony. Markets today rise not because they're strong, but because no one dares to believe they'll fall. Behind every market move lies code. Algorithms don't feel fear or excitement. They follow patterns. Millions of trades per second, all reacting faster than humans ever could. This automation creates the illusion of stability. But when all machines follow the same logic, chaos spreads faster than reason. In today's market, the heartbeat isn't human anymore. It's artificial. The U.S. stock market stands not just on faith, but on dominance. The dollar remains the world's reserve currency, the ultimate safety net. Foreign investors pour trillions into American assets, not because they love risk, but because they fear alternatives. As long as the dollar stands tall, the market stands taller. It's a global monopoly of trust, one that even crises struggle to break. Underneath the market's confidence lies a mountain of debt. Governments borrow, companies borrow, consumers borrow, all feeding the illusion of prosperity. Debt isn't a flaw, it's fuel. The problem? Fuel burns. Every boom plants the seeds of its own bust. Yet for now, the engine roars on, powered by tomorrow's promises. Tech stocks became the backbone of optimism. Apple, Microsoft, Nvidia, they're not just companies, they're symbols of hope. Even when profits dip, stories about the future keep valuations alive. Innovation has become mythology. The market needs these giants to stand tall because they're not just assets, they're anchors of belief. During the pandemic, a new class of investors rose, ordinary people with apps. Reddit threads, viral memes, and online crusades turned markets into digital battlegrounds. The GameStop saga showed one truth. The market isn't just numbers, it's emotion. Millions now move prices not with capital, AR, but with conviction. We're told to diversify, but in a hyper-connected market, everything moves together. When one domino falls, the rest follow. Bonds, stocks, crypto. Once separate worlds, now share the same fate. Diversification feels safe, but in truth, we've built one giant ecosystem of risk. Financial media doesn't just report, it narrates. Every headline shapes behavior. Fear sells, but hope sustains. A single optimistic forecast can lift billions in value. In the age of instant news, the market reacts not to facts, but to feelings. Behind every market miracle lies a steady hand of public spending. Defense contracts, green energy subsidies, and infrastructure bills all funnel billions into corporate veins. The state isn't separate from the market, it's part of its bloodstream. The two now move as one organism, a capitalism with state support. Inflation quietly eats away debt, resets prices, and hides systemic pain. For investors, it's both villain and savior. As long as inflation remains manageable, the illusion holds. Too low. Stagnation. Too high. Panic. The Fed walks a tightrope between truth and collapse. The stock market isn't just American, it's global. Asian factories feed U.S. profits. European investors feed U.S. bonds. When one trembles, all feel the shake. It's a chain of dependence wrapped in optimism. The system's strength lies not in its health, but in its size. Every crash teaches the same lesson. It always recovers. That belief has become the market's immune system. Investors buy the dip, confident history repeats. But what if history changes? Each bailout makes the system stronger, but also more fragile. The market survives not because it's unbreakable, but because we refuse to let it break. While stocks rise, millions struggle with rent, healthcare, and debt. The market's strength often masks human weakness. Prosperity isn't evenly shared, it's concentrated. Behind the glowing charts are silent faces left behind. The miracle of survival hides a deeper imbalance, one the numbers will never show. Markets live on confidence. When that confidence breaks, no policy can save it. The fall doesn't start with numbers, it starts with emotion. Fear spreads faster than facts, and in that moment, all the hidden reasons, all the invisible supports vanish. What's left is the truth, an economy that forgot what it was built on. So, why is the stock market still standing? Because it must. Because our modern world is wired into it. Savings, pensions, power, politics. The system isn't designed to reflect reality, it's designed to preserve itself. The hidden reason is survival. The market doesn't stand because it's strong. It stands because it cannot fall. Not yet.